Welcome to the review session on depreciation. Before we get started with the questions, I'll tell you something in brief about this chapter. Depreciation is defined as the permanent and continuous decline in the book value of an asset. So the definition is there is going to be a permanent and a continuous decline in the book value. So what we are keeping in mind here is the book value. Whether the market price of the asset increases or decreases, we are not going to take cognizance of that when we calculate depreciation, except when assets are getting revalued. Otherwise, we are going to keep depreciating the book value of the asset. Depreciation is a non-cash revenue expenditure, and we provide depreciation in accordance with the accrual concept, the going concern concept, and the matching concept. When we buy an asset, it is a capital expenditure and we show it in the balance sheet as an asset, and we use that asset to earn revenue, and we need to match all the revenues that we earn with the costs that are incurred to earn that revenue. And one of the modes of matching, one of the costs that is incurred in order to earn revenues is the depreciation on the assets that are being used to generate that revenue. See, there are various methods of providing depreciation. You have the straight line method, the WDV method, and there are various other methods which are variations of these two methods. There is the sum of the digits method, then there is machine hours method, then production units method, annuity method, sinking fund method. So these are some of the methods that are used for depreciating assets. The terms depreciation and amortization can be used interchangeably. Cannot, in the sense that the concept of the terms depreciation and amortization is the same. Intangible assets like trademarks, licenses, patents are amortized, while the tangible assets are depreciated. And there are certain assets like land which is not depreciated because it is not possible to estimate the useful life of land. So there is no useful life, or there is no terminable period for land, and hence we do not depreciate land. Another term that we must know is what is the meaning of the term written down value, or the book value, or the carrying value of an asset. The carrying value or the book value of an asset is nothing but the cost of the asset minus the depreciation that has been charged on the asset so far. Okay, and we know the definition of the term cost. We saw it when we did the chapter capital expenditure and revenue expenditure. So cost is nothing but the basic purchase price of the asset plus all expenses that are incurred in order to bring the asset to its present location and conditions. So the installation charges that are incurred, the freight that is paid to get the machinery or the asset to the premises, all these will be included as part of cost of the asset. Another thing that we should keep in mind is the date from which the asset is to be depreciated. The asset is to be depreciated not from the date on which it's been purchased, but from the date on which it is available for use. So let us say an asset is purchased on 1st April 2012. It is available for use from 1st May 2012, but it is put to use from 1st June 2012. Then we'll be depreciating the asset from 1st May 2012 because that is the date on which it was available for use. So this is just in brief about what this chapter is. We'll get into the details when we look at the questions one by one. So we'll start with the first question. Depreciation accounting is a process of valuation of fixed asset, a process of allocation of the cost of fixed asset, a method of providing funds for replacement, none of these. See, the answer is it's a process of allocation of the cost of the fixed asset. It is through depreciation that we are releasing the cost of the asset through the P&L account. Okay, so the answer to this question is B. Next, depreciation is A cash expenditure like other expenses, a cash operating expense, a non-cash non-operating expense, a non-cash operating expense. It is a non-cash operating expense. It is non-cash because there is no cash outflow when we depreciate an asset, and it is definitely related to the operating activities of the business, and so it is a non-cash operating expense. Depreciation in subsequent years is a fall in the book value of an asset other than the first year. So as I told you, depreciation is a continuous and permanent decline in the book value of an asset. So the answer is B. The main causes of depreciation include physical wear and tear, passage of time, changes in economic development, which is otherwise called obsolescence, all of the above. Well, depreciation can be caused by all these three causes. Asset, when it's used, there is physical wear and tear, passage of time. If the asset is not being used for a particular period of time, even then it depreciates. Changes in economic development, technological development, because of which the assets become obsolete, and so that also leads to fall in the value of the asset. So answer is D, all of the above. The methods of recording depreciation are straight line and WDV, charging to asset account, crediting to provision for depreciation or accumulated depreciation account, B and C. See, the question is what are the methods of recording depreciation. Here the question doesn't say what are the methods of computing depreciation, it is methods of recording depreciation. Depreciation, one option is charging to the asset account, where we debit depreciation and credit the asset account. The other method is we debit depreciation and we keep accumulating the depreciation relating to that asset in a separate account called the accumulated depreciation account or the provision for depreciation account. So the answer is B and C. When depreciation is recorded by charging to the asset account, the asset appears at original cost less depreciation. Okay, so answer is B. Depreciable assets are assets which are expected to be used during more than one accounting period, have a limited useful life, are held by an enterprise for use in the production or supply of goods and services, for rental to others, or for administrative purposes, and not for the purpose of sale in the ordinary course of business. All of the above. Yes, answer is D, all of the above. So that is what distinguishes a depreciable asset from a current asset. They are expected to be used during more than one accounting period, they have a limited useful life, and they are held by the enterprise for either use in the production of goods and services or for rental. That is, suppose there's a business that has many buildings and it is holding these buildings only for the purpose of letting it out to others to get rental, or for administrative purposes, then such assets are called depreciable assets. Next, useful life of a depreciable asset should be estimated after considering, yes, expected physical wear and tear, obsolescence, legal or other limits on the use of the asset. All of the above. Yes, so the answer is D, all of the above. Which of the following assets is usually assumed to be not depreciating? Land is assumed to be not depreciating because it is not possible to estimate the useful life of land. So A is the answer. Consider the following data pertaining to Messrs. E Limited, who constructed a cinema house. Particulars: cost of second-hand furniture, cost of repainting the furniture, wages paid to employees for fixing the furniture, fire insurance premium. Okay, so the amount debited to furniture account will be, right, so the basic cost is 90,000. Since it's second-hand furniture, you cannot use the furniture unless it is repainted. So 10,000 will also be part of cost of the asset. So it now becomes 1 lakh. Wages paid to the employees for fixing the furniture, that is also part of the cost of the asset. So now the cost becomes 1,02,000. Fire insurance premium is a recurring expenditure and it is not a capital expenditure. So the answer is lakh and 2000 rupees. Which of the following expenses is not included in the acquisition cost of a plant and equipment? Cost of site preparation, yes, it is included in the acquisition cost of plant and equipment. Delivery and handling charges, that is also to be included as part of cost. Installation costs, yes, it is a capital expenditure. Financing costs incurred subsequent to the period after plant and equipment is put to use, this is a revenue expenditure. But if financing costs are incurred up to the period the plant and equipment is put to use, that will be added to the cost of the asset. So in this problem, answer is D. This financing cost which is incurred after the period after which the plant is put to use is revenue expenditure. Next, depreciable amount is the difference between the historical cost and the estimated salvage value. So historical cost is the cost that is incurred to acquire the asset, and at the time of acquisition of the asset itself, the business will have to estimate the salvage value that it will get when it scraps the machine at the end of its useful life. So this difference between the historical cost and the amount that you expect to realize at the end of its useful life is called the depreciable amount, and this is what is in fact getting depreciated over the useful life of the asset. Which method is followed to have a uniform charge for depreciation and repairs and maintenance together? Okay, so we know that the WDV under the WDV method, the amount of depreciation charged to the profit and loss account every year will diminish as the asset grows older, because the depreciation is calculated on the written down value of the asset every year. So if we want to have a method where the charge to the P&L with respect to depreciation and repairs together is going to be the same over the life of the asset, then we'll have to go for the written down value method, because the depreciation charge under the written down value method will keep diminishing, while the repair and maintenance cost will keep increasing as the asset ages. So when we take a summation of the depreciation charge and the repairs charge on a year to year basis, the total charge will be evened out, and the charge to the P&L will be uniform. So answer is A. Next, date of purchase of machine is 1/7/2006. Purchase price of machine is 80,000. Installation charges are 20,000. Residual value is 40,960. Useful life is 4 years. Date when the machine is put to use is 1/10/2006. We are required to find out the depreciation for the year 2006-2007. So what we have to keep in mind here is we have to depreciate the asset from the date on which it was put to use. So we will depreciate the asset from 1/10/2006 to 31st March 2007 for the financial year ending 31st March 2007. So this asset is going to be depreciated for 6 months for FY 2007. Next is, what is going to be the depreciation charge? We know that the purchase price of the machine plus the installation charges is totally, it comes to 1 lakh. So the cost is 1 lakh, and we know the residual value. So the residual value is 40,960. So the difference between cost and residual value is called the depreciable amount. Depreciable amount is equal to 59,040, and the useful life is 4 years. So the depreciation per annum under SLM will be 59,040 divided by 4, which is 14,760. But for FY 2007, we have to depreciate the asset only for 6 months, so the depreciation is going to be half of this, which is 7,380. So the answer is 7,380. Next, Purchase price of machine is 75,000, installation charges 25,000, residual value is 40,960, SLM rate of depreciation is 14.76%, useful life of machine is how much? Okay, so here we know that the historical cost is 1 lakh, the residual value is 40,960, and the SLM rate of depreciation is 14.76% per annum. Okay, so rate of depreciation under SLM is 14.76%, which means depreciation per annum is equal to 14.76 multiplied by 1 lakh. Okay, so my annual depreciation is 14,760, and they're asking us to find out what is the useful life of the machine. We know that the depreciable value is 1 lakh minus 40,960, which is 59,040. So for 59,040, if it is written off, if we write off 14,760 from 59,040 every year, in how many years will this become zero? It will be this divided by depreciable amount divided by depreciation per annum is the useful life. Okay, so answer is 4 years. Next. Okay, date of purchase is 1/7/2006. Purchase price of machine is 90,000 rupees. Installation charge is 10,000. Accounting year, which is a financial year. Date when the machine was put to use is 1st October. Useful life is 4 years. Depreciation under SLM for the year 2006-2007 is 7380. They're asking us to find out the residual value of the machine. Okay, so we know that depreciation for 6 months is given to us, which is 7380. Therefore, depreciation for full year will be double. Okay, and we know that the useful life is 4 years, which means the depreciable amount is going to be 59,040. This is the depreciable amount, depreciable value, and we know that the residual value is 40,960. With this we can find out the cost as depreciable value plus the residual value. So the answer is 40,960. So this is the balancing figure. Next, original cost is 1,26,000, salvage value is 6,000, useful life is 6 years. The annual depreciation under SLM will be original cost minus salvage value. 1,20,000 is our depreciable amount divided by 6 years. So 20,000 is the annual depreciation. X Limited purchased a machine for 1/1/2003 for 2,40,000. Installation expenses were 20,000, which means our cost becomes 2,60,000. Residual value after 5 years is 10,000, which means our depreciable amount is 2,50,000. They're incurring some expenses for repairs, which is not relevant to us because that's a revenue expenditure. Depreciation is provided under straight line method. What is the depreciation for the 4th year? So our depreciable amount is 2,60,000 minus 10, 2,50,000. 2,50,000 divided by 5 is 50,000. So annual depreciation is 50,000. So every year, whether it's the first year, second year, or the 5th year, depreciation for 5 years is going to be 50,000 rupees each. Answer is D. Next. X Limited purchased a machine on 1/1/2007 for 2,40,000. Installation expenses for 20,000, which means our cost becomes 2,60,000. Residual value is 10,000, so it becomes 2,50,000. The depreciable amount becomes 2,50,000. On 1/7/2007, expenses for repairs were incurred to the extent of 4,000 rupees. Okay. Depreciation is provided under straight line method. Okay, it should be depreciation is provided under the WDV method, and they're asking us to find out the depreciation for the fourth year. So here we have to what we have to do is the depreciation rate is 10%. When the rate of depreciation is given to us, we should ignore the information with respect to residual value that's given to us, because when we calculate the depreciation rate, we have already taken into account the value of the scrap or the salvage value that is expected to be realized at the end of the life. So when the depreciation rate, whether it is the SLM or the WDV, when the depreciation rate is given to us in the problem, it has to be directly applied on the cost of the asset and not on the depreciable amount. So what we'll do here is we'll start with 1/1/2007, that's when the asset was purchased, for 2,60,000. Okay, so depreciation is provided in the straight line method. Okay, we have to directly apply 10% on 2,60,000. Depreciation under SLM will be 10% of 2,60,000, which is 26,000 rupees. So answer is A. In the year 2006-07, CAS Limited purchased a new machine and made the following payments in relation to it. Cost as per suppliers list less agreed discount, delivery charges, erection charges, AMC, additional components to increase capacity of the machine, annual insurance premium. So in this in all these expenses or this expenditure that the company has incurred, what can be capitalized towards the cost of the asset are the basic cost, that is 9,40,000, plus 20 becomes 9,60,000, plus 40 it becomes 10 lakhs, and AMC and annual insurance premium are not in the nature of capital expenditure. Those expenses are incurred only to maintain the existing earning capacity and not to enhance the earning capacity of the asset, and hence we'll include only 80,000 in addition to the 10 lakh that we've already arrived at, and the cost of the machine will be 10,80,000 rupees. Suppose that the asset is depreciated at 10% per annum. The depreciation for the third year will be 1,08,000. It doesn't matter which year it is, because under SLM the depreciation charge is going to be the same throughout the life of the asset. So answer is 1,08,000. Next is, if the depreciation is provided at 10% per annum WDV, what is the depreciation for the third year? Okay, so at the beginning of the first year, okay, at the beginning of the first year, the cost of the asset is 10,80,000, and the depreciation charge will be this into 10%, and the WDV at the end of the year will be 9,72,000 rupees. Okay, so for the second year, depreciation will be on the written down value at 10%. So the WDV at the end of the second year will be 8,74,800. For the third year, depreciation will be on 8,74,800 at 10% per annum, and which will give us a written down value of 787,320. So answer is 87,480. Next, the balance in the accumulated provision for depreciation account of a company as at the beginning of the year 2006-2007 was rupees 2 lakhs, when the original cost of the assets amounted to rupees 10 lakhs. The company charges 10% depreciation on a straight line basis for all the assets, including those which have been either purchased or sold during the year. One such asset costing rupees 5 lakhs with accumulated depreciation as at the beginning of the year of rupees 80,000 was disposed of during the year. What is the depreciation for the year? See, here in this problem we must understand one thing, that the company's policy for charging depreciation is not on a pro rata basis. it says the company charges 10% depreciation on a straight line basis for all the assets, irrespective of whether they've been purchased or sold during the year. So even if an asset has been sold during the year, it is depreciated for the full year before we account for its sale. Similarly, an asset that's been purchased is depreciated for the full year as if it has been purchased on the first day of the year, and sale is considered as if it's been sold on the last day of the year. So keeping this in mind, we have to find out the depreciation for the year. Opening gross block, that is at the beginning of the year, the original cost of the assets that the company had is rupees 10 lakhs, and the company has a policy of charging 10% depreciation on a straight line basis. So since there is another clause to it which says that it is as if the asset, whether it's purchased or sold, it is charged with full year depreciation. It doesn't matter to us whether an asset, we know that an asset costing 5 lakhs has been disposed. So the date of disposal doesn't matter to us. It would still have to be depreciated at 10% for one full year, which means we can directly apply 10% on 10 lakhs, and 1 lakh will be the depreciation charge for the year. Okay. Continuing that question, the second question is, it says, what will be the balance in the accumulated depreciation account at the end of the year considering the current year's depreciation charge? Okay. So we know that the opening balance of ACDEP is 2 lakhs, and the depreciation charge for the year is 1 lakh. So this brings us to 3 lakhs. But an asset has been disposed of. The asset had an opening accumulated depreciation balance of 80,000. Okay, and during the year the depreciation pertaining to that asset is 50,000 rupees, which means this 3 lakhs includes accumulated depreciation of 1,30,000 with respect to an asset that's been disposed of, and so we have to remove the depreciation pertaining to the asset that's been disposed of, and so now the balance will be the accumulated depreciation pertaining to the asset that's continuing in the business, right? So the answer is 1,70,000. Next, X Limited, which depreciates its machinery at 10% per annum on diminishing balance method, had on 1st April 2006 some balance to the debit of machinery account. It purchased a new machine for 1,90,000 on 30/9/2006 after incurring 10,000 rupees. After providing depreciation, the closing balance of machinery account as at 31/3/2007 is 10,64,800. What is the original cost of old machines purchased on 1/4/2004? Okay, so we know that the written down value of the machinery as at 31st March 2007 is 10,64,800, and they are asking us to find out the original cost of the machines that were purchased on 1/4/2004. So we have to work backwards from 10,64,800, that is from 31/3/2007 up to 1/4/2004, right? So let's do this. On 31/3/2007, the written down value of the machine is 10,64,800, right? And this 10,64,800, we have to keep in mind, includes not just the written down value of the old machine, it also includes the written down value of the machine that was purchased 6 months back, that is on 30/9/2006 for rupees 2 lakhs, right? That is, I'm including the 10,000 rupees for installation or freight or whatever, right? So let us find out the WDV of the new machine that was purchased on 30/9/2006. So on 30/9/2006, a machine costing 2 lakhs has been purchased. So from 30/9/2006 to 31/3/2007, this machine will be depreciated at 10% for 6 months, right? So this into 10% into 6 divided by 12 is the depreciation for 6 months, and so the WDV as at 31st March 2007 is 1,90,000. And since we are required to find out the the cost of the old machines, let us remove the WDV of the new machine from the total WDV as at 31st March 2007. Okay, so now we have this number, which is the WDV of the old machines as at 31st March 2007. Now we have to work backwards. We have to find out what is the value of the machine on 31st March 2006. We know that the assets have been depreciated at 10% per annum on diminishing balance method, which means that this value, that is 874,800, will be 90% of what it was on 1/4/2006 or 31/3/2006. So the value on 31/3/2006 will be this divided by 0.9 or 90%. It gives us 9,72,000. Now we go back 1 year, and the same way we divide this by 0.9, which will give us 10,80,000. Now we have to go back 1 more year, divide this by 0.9, and we get 12 lakhs as the original cost of the old machines. Next, on 1/4/2006, the balance of machinery account was 4,71,200. It was discovered during 2006-2007 that 50,000 rupees, being the cost of generator purchased on 1st October 2003, had been written off to stores. After rectification and depreciation at 20% per annum on reducing balances, what will be the balance of machinery account on 31/3/2007? See, which means a capital expenditure has been treated as a revenue expenditure, and they have discovered it later. Now they want to include the WDV of the generator to the balance of the machinery account, right? So first let us find out what will be the WDV of the generator as at 31/3/2007 to be included along with the WDV of the other machinery. Okay, so this generator, which was purchased on 1st October 2003 for 50,000 rupees. Okay, so for the year ending 31st March 2004, it will be depreciated only for 6 months. So depreciation will be into 20% divided by 2, which means the written down value is 45,000. Okay, so this is for FY 2004. Next, for FY 2005, the depreciation will be 45,000 into 20%. Okay, so our WDV will be 36,000 for FY 2005. For FY 2006, it will be 36,000 into 20%, and the WDV will be 28,800. FY 2006. For FY 2007, it will be 28,800 into 20%, and the WDV will be 23,040. Okay, so the WDV of the generator, which is to be included along with the WDV of the other machinery, is 23,040. Right? Now let's find out the WDV of the other machinery as at FY 2007, because what's given to us is at 1/4/2006. So 471,200 is as at 1/4/2006 and has to be depreciated for 1 year. So which means as at 31/3/2007, it will be 80% of this value. After depreciating for 20%, it will be 80% of this value. And so now to this we have to include the value of the generator that's not been included so far, and the value of the machinery now, or the written down value of the machinery now, will be 4 lakhs. Next, A new machine costing rupees 2 lakhs was purchased by a company to manufacture a special product. Its useful life is estimated to be 5 years and scrap value at rupees 20,000. The production plan for the next 5 years using the above machine is as follows. Year 1, okay, for year 1 to 5 the plan is given to us. They're asking us to calculate the depreciation for the fourth year under the units of production method. Okay, so depreciation under the units of production method, our first step will be to calculate the depreciable value. Okay, so the depreciable value for this asset is lakh and 80,000 rupees. 2 lakhs minus 20,000, depreciable amount is lakh and 80. Okay, and our next step will be to find out the total production capacity. Total production capacity is nothing but the summation of the units that is expected to be produced by the machine from year 1 to year 5. So it is 5 plus 10 plus 12 plus 20 plus 25, which will give us 72,000 units. Okay. Our next step is to calculate what is the depreciation per unit, which means the asset, if it produces 1 unit, it gets depreciated by rupees 2.5. So for every unit that is being produced, the asset gets depreciated by rupees 2.5. And we are required to find out the depreciation for the fourth year. Fourth year output is 20,000 units, and so depreciation will be 2.5 into 20,000 units, which is rupees 50,000. Depreciation for the fourth year is 50,000 rupees. Okay. Next, X Limited purchased a machine for 2,20,000 rupees on 1st Jan 2001 and incurred rupees 40,000 towards freight, insurance, carriage inwards and installation charges. It was estimated that the machinery will have a scrap value of rupees 20,000 at the end of its useful life, which is 10 years of rupees 12,000 hours each. X Limited decided to depreciate the machines on machine hour rate method. The machine hours during the first 6 years were as under. Okay, so here machine hour rate method is, we have to find out the depreciation per machine hour. Okay, again depreciation per machine hour. So our first step will be to find out the depreciable amount. Depreciable amount in this case will be 2,20,000 plus 40,000 is 2,60,000 minus the estimated salvage value is 20,000, so it's 2,40,000 is our estimated salvage value. And the estimated useful life of the asset in terms of machine hours is 1,20,000 hours, which is 12,000 hours into 10 years of life, so 1,20,000 hours. So essentially we have to write off 2,60,000 minus 2,40,000. This is the depreciable amount, and this is to be written off over machine hours over its life is 12,000 into 10, and so depreciation per machine hour is equal to 2 rupees 2. And depreciation for 2006, it's expected to run for 12,000 hours in 2006, and so depreciation will be 24,000 rupees. Next, original cost is 1,36,000, salvage value is 10,000, useful life is 6 years, depreciation for the first year under sum of years digits method will be. Okay, so under the sum of years digits method, depreciation is calculated as original cost minus salvage value. See, in this problem, original cost is 1,36,000 rupees salvage value is 10,000 rupees. Okay, so this gives us the depreciable amount of lakh and 26,000 rupees. Okay, now after this, calculating depreciation under sum of years digits method will be, we have to find out the number of years of remaining useful life. Okay, we are calculating depreciation for the first year, so the remaining useful life is 6 years, that is including the first year, how many years of remaining useful life, so it is 6 years. And we have to find out the sum of the digits, of the number of years of useful life. That is, if the here in this case the useful life is 6 years, so we have to find out the sum of 1 plus 2 plus 3 plus 4 plus 5 plus 6, so 1 to 6. So this is an arithmetic progression, and to find out the sum of an arithmetic progression where the the difference between every item in the progression is 1, it the formula is n into n plus 1 by 2, where n is the number of observations in the arithmetic progression. So it will be 6 into n plus 1. So 6 plus 1 divided by 2. So that gives us 21. So the depreciation under this method will be the depreciable amount multiplied by number of years of remaining useful life divided by the sum of the digits in the sum of the digits in the useful life. So depreciation is 36,000 rupees for the first year. Next, H Limited purchased a machinery on 1st April 2003 for 3,10,000 rupees. It's estimated that the machinery will have a useful life of 5 years, after which it will have a salvage value of rupees 10,000. So, which means a depreciable amount is 3 lakhs. If the company follows sum of the years digits method of depreciation, the amount of depreciation charged during the year 2006-2007 is how much? Okay, so here 2006-2007 will be, it's purchased on April 1, 2003. So the first year ends on March 31, 2004. Then March 31, 2005, that's the second year. Third year will end on March 31, 2006, and the fourth year will end on March 31, 2007. Right, and we are required to calculate the depreciation using the sum of the years digits method for the fourth year, where the useful life is 5 years, which means a remaining useful life is 2 years. Okay, so we'll just change the data. It is 3 lakh, original cost is 3 lakh 10, so that gives us the depreciable amount of 3 lakhs. Number of years of remaining useful life is 2, right, and sum of the digits will be, the useful life is 5, right, so depreciation will be 40,000 rupees. Next, date of purchase of an asset is 1/1/2005. Purchase price of machine is 60,000 rupees. Installation charges is rupees 20,000. On 30th September 2006, this machine was sold for 50,000 rupees. Depreciation is to be provided at 20% per annum according to the WDV method. Accounts are closed on 31st March every year. What is the loss on sale of the machine? Okay, so to find out the loss on sale of the machine, we have to first of all find out the written down value of the asset as at 30th September 2006. So let's start with 1/1/2005. 1/1/2005, asset is purchased for 60,000 plus 20, 80,000. Okay, so the depreciation for the year ending 31st March 1/1/2005 to 31st March 2005. So it is Jan, Feb and March. So it's depreciated for 3 months for the year FY 2005. So 80,000 into 20% for 3 months into 3 divided by 12. Okay, so the depreciation is 4,000, the WDV becomes 76,000. Next, what's happening? On 30th September 2006, this machine is sold for 50,000 rupees. Okay, so there it's getting depreciated for one full year. Okay, it's getting depreciated for one full year, that is 1 4 2005 to 31 3 2006. Okay, so it is depreciation will be 76,000 into 20%. Okay, so the written down value is 76,000 minus 15,200, which is 60,800. Right, I think we need to change the question. The purchase price of the machine is 80,000, so it becomes 1 lakh. This is not 60, it is 1 lakh. Okay, so the WDV as of 31st March 2006 becomes 76,000, and then it's sold on 30th September, which means it's getting depreciated only for 6 months. Okay, so depreciation will be 76,000 into 20% into 6 divided by 12. Okay, so the WDV as on the date of sale is 68,400. So an asset having a WDV of 68,400 is sold for 50,000, which means there is a loss of 18,400. Next, on 1st October 2003, two machines costing 40,000 and 30,000 respectively were purchased. On 31st March 2007, both the machines had to be discarded because of damage and had to be replaced by two machines costing 50,000 and 40,000 respectively. One of the discarded machines was sold for 12,000 rupees, and against the other it was expected that rupees 10,000 would be realized. The firm provides depreciation at 15% per annum on WDV. You are required to find out depreciation for the year 2005-2006. Okay, so okay, so you have machine 1 and machine 2. Okay, so the cost of it was purchased on 110. The date of purchase we know is 1/10/2003. Okay, and the cost of the machine is 40,000 and 30,000. Okay, right, so next we are required to find out depreciation for the year FY 2006 2005 2006. So depreciation for FY 2004 will be only for 6 months because the asset was purchased on 1/10/2003. Okay, depreciation is 15%, so it will be 40,000 into 15% into 6 divided by 12. Okay, so the WDV becomes, right, next for FY 2005 it will be this into 15%, and the WDV becomes, okay, so FY 2006, that's what we are required to find out. Depreciation will be this into 15%, and the total charge will be this plus this. Okay, so 8256 is the answer. Continuing the same problem, it says, what is the total amount of depreciation written off on the two machines till they were discarded? Okay, they are discarded on 31st March 2007, so we need to depreciate it for another asset, for another year, sorry. We need to depreciate it for another year, so WDV becomes this. Okay, so depreciation for FY 2007 is depreciation for FY 2007 is this into 15%, and the WDV as at 31/3/2007 will be, okay, so we have this. Okay, so the WDV is so much, and we are required to find out by how much has the asset been totally depreciated. So the WDV of both the assets now is 39,764. When they were purchased, the cost was 70,000. So this is the difference. This difference is what has been written off. 30,000 to 36. This is what has been written off till 31/3/2007. Okay. Next, on 1st April 2004, X Limited purchased a machinery for 12 lakhs. On 1st October 2006, a part of the machinery was a part of the machinery purchased on 1/4/2004 for 80,000 was sold for 45,000, and a new machinery at a cost of rupees 80,000 was purchased and installed on the same date. The company has adopted the method of providing 10% per annum depreciation on the original cost basis. Original cost basis means on the basis of on the straight line method. Okay, you're required to find out the closing balance of the provision for depreciation account as at 31st March. Closing balance, okay, as at 31st March 2007, right? So on 1st April 2004, an asset costing 12 lakhs has been purchased, right? And a portion of it is being sold only on 1st October 2006. So we'll depreciate the asset for FY 2005 at lakh and 20. Okay, FY 2006 also at lakh and 20. FY 2006 ends on 31st March 2006, and the sale is happening only during FY 2007. It's happening on 1st October 2006, right? Next, so for FY 2007, depreciation on the asset sold. Depreciation on the asset sold will be 80,000 into 10% for 6 months. Okay, it will be 80,000 because the depreciation is on original cost and the asset has been used only for 6 months. So on the new asset it will be 4,000 rupees. Okay, next, depreciation on the new asset will be similarly 4,000 rupees because it was purchased on the date on which the asset was sold, and so it has been used for the remaining 6 months, and so depreciation on the new asset is 4,000. Depreciation on the old asset will be, see now, opening we had 12 lakhs, that is a gross block of the asset is 12 lakhs on which 80,000 is sold, but a new asset of 80,000 is purchased on the same date. Okay, so again 12 lakhs will be subjected to depreciation of 1 year, which is lakh and 20, right? And the question is, what is going to be the accumulated depreciation balance? It will be depreciation for 2005 plus 2006 plus depreciation for 2007. So answer is 3,68,000 rupees. Next, date of purchase of machine is 1/4/2004. Cost is 12 lakhs. Rate of depreciation is 10% per annum on written down value basis. On 1/10/2007, a new machinery was purchased for rupees 80,000. What is the closing balance of the provision for depreciation account as at 31/3/2007? Okay, So 1/4/2004 an asset is purchased. Okay, the cost of this asset is 12 lakhs. Okay, so depreciation for FY 2005 will be lakh and 20,000. So the written down value becomes 10,80,000 rupees. Okay, now depreciation for FY 2006 will now be into, sorry, this into 10%, which is lakh and 8,000 rupees. And so now the WDV as at 31st March 2006 becomes 10 lakh 80 minus lakh and 8, which is 9 lakh 72. Okay, and they're asking us what is the closing balance of the provision for depreciation as at 31st March 2007. Okay, so FY 2007 depreciation will be this into 10%, right? So the accumulated depreciation balance as at 31st March 2007 will be 97,200 plus lakh and 8 plus lakh and 20, which is 325,200. Okay, see, the new machinery has been purchased on 1st October 2007, which means this event is happening during FY 2008, and we are looking at the closing balance of provision for depreciation as at 31/3/2007, and so the answer is 325,200. Next, on 1st Jan 2001, Tushar Limited purchased a machine for rupees 20,000 and provided depreciation at 10% per annum. At the end of 2004, the company decided to change the method of depreciation from WDV to straight line method, the rate of depreciation remaining the same. Okay. See, change in method of depreciation is a change in the accounting policy, and the effect has to be given retrospectively. Okay, the effect is not prospective but retrospective, as if we had applied the new method of depreciation from the date on which the asset was actually put to use. So here the company has been depreciating the asset using WDV, but now they want to change it to SLM, right? So now let's see how to go about this. Our first step will be to calculate the depreciation that has been charged so far on the asset. So on 1/1/2001 an asset has been purchased for 20,000 rupees. Okay, so for FY 2001, it is the calendar year, so the for FY 2001 depreciation is 2,000 under the WDV method. Okay, so as at 1/1/2002, the WDV is 20,000 minus 2,000. So for FY 2002, depreciation will be 1,800. Okay, so on 1/1/2003, the WDV will be 18,000 minus 1,800. So for FY 2002, depreciation will be this into 10%. Okay, so 1/1/2004, the WDV will be this. Okay, and for depreciation for FY 2004 will be 1,458. Okay, next, what happens, they want to change the method of depreciation from the written down value method to the straight line method. Okay, so depreciation under straight line method. Okay, so they, at the end of the year, they want to change it, which means that let us stop here. Okay, so we have to depreciate this asset under SLM method for 1, 2, 3 years. So it will be 20,000 into 10% for 3 years. which is 6,000 rupees. Depreciation that has been charged so far under the WDV method is 2,000 plus 1,800 plus 1,620, which is 5,420. Which means the company has charged depreciation of 5,420 so far, while it should have charged 6,000 rupees had it followed the SLM method right from the date on which the machinery was put to use. Which means the short depreciation that's been charged so far is 580, and this will be the excess charge to the P&L this year. Next, Tushar Limited, which depreciates its machinery at 10% per annum on diminishing balance method, had on 1st April 2004 29,160 to the debit of machinery account. Okay. On 31st March 2005, the company decided to change the method of depreciation to SLM with effect from 1/4/2001. The rate of depreciation remaining the same. Okay, so we have the WDV as at 1/4/2004. 1/4/2004, the WDV is 29,160. Right, and we don't know what is the cost of the asset or what was the WDV of the asset on 1/4/2001. That is the date from which they want to change the method of depreciation. So we have to work backwards from 1/4/2004 to 1/4/2001 using the rate of depreciation. So the WDV of the asset on 1/4/2003 would have been this by 0.9. Okay, on 1/4/2002 it would have been this divided by 0.9. On 1/4/2001 it would have been this divided by 0.9. Okay, which is 40,000 rupees. Okay, so which means that the asset has been depreciated by 10,840 rupees under the WDV method. So depreciation under WDV method is 10,840 rupees. That is the WDV or the cost of the machine on 1/4/2001 and the WDV now. The difference between that will give us the depreciation that has been charged under WDV. But now they want to change the method to SLM with effect from 1/4/2001. So depreciation per annum will be 4,000 rupees, and if we depreciate the asset for 4 years, total depreciation under SLM will be 4,000 into 4, which is 16,000 rupees. Okay, and it says as on 31st March 2000 on 1st April 2004, on 31st March 2005 the company decided to change the method of depreciation to the straight line method. Okay, so answer is 5160. Okay, they are asking us what is the, on account of the changed method of depreciation, okay, what is the short depreciation that is to be provided. Okay, so 2001 to 2000, okay, so from 2001 to 2002 it is 4,000, 2002 to 2003 it is 4,000, 2003 to 2004. Okay, so which means depreciation under SLM would have been 12,000 rupees, right? That is from 1/4/2001 to 31st March 2003. Okay, that is 3 years, and so the depreciation would have been 12,000 rupees, while under the WDV method it has been 10,840, and so the short depreciation that is to be charged is 1160, right? Next, B Limited has been charging depreciation on the straight line method. It charges a full year depreciation even if the machinery is utilized only for part of the year. An equipment which was purchased for 3,50,000 rupees now stands at 2,97,500 after depreciating at the rate of 5% on a straight line basis. Now the company decides to change the method of depreciation with retrospective effect. The applicable reducing balance rate for this machinery would be 8% per annum. Assuming that before the effect of this change could be accounted, depreciation for the current year has already been charged and is based on straight line method and is reflected in the depreciated value of 297,500. The extra depreciation to be provided based on the changed method during the year is how much? Okay. So here we know that the cost of the asset that was purchased is 3,50,000 rupees. Okay, and it is now standing at WDV, or the book value of the asset is 2,97,500. Okay, which means the asset has been depreciated totally for 52,500 rupees. The depreciation per annum is 3,50,000 into 5%. Right, which means the age of the asset, or the asset has already been depreciated for 3 years. The asset has been depreciated for 3 years under the straight line method. Now they want to change the method of depreciation and apply the written down value method of depreciation at 8% per annum. So we have to start from 3,50,000. Okay, so 3,50,000 depreciation for the first year will be 3,50,000 into 8%. Okay, so now our WDV becomes 3,22,000. Depreciation for the second year will be 3,22,000 into 8%. Okay, so which gives us a WDV of 296,240, and the depreciation for the third year will be 296,240 into 8%, which is 23,700 approximately, right? So the total depreciation charge under the WDV method is 28 plus 25,750 plus, which is 77,460. Okay, and the depreciation that's been charged so far is 52,500, which means the shortfall that is to be charged is 24,959. Okay, so with this we conclude the review session on depreciation accounting. In case you have doubts, please feel free to get in touch with me at queries@greymatteracademics.com. So until next time, goodbye.